Thank you, Madam Chair. Thank each one of you as individuals for participating today. It is the same story that we hear as we go around the district. I represent the Southern District of New Mexico. Our per capita income is about $30,000 to $35,000. Small communities, and so your story is exactly the one that we hear. Kind of starting where Mr. Meeks was discussing that he went to college because his parents could get one of those non-standard loans that Mr. McHenry was talking about, and in fact that's my story too. There were 6 kids, and I was signing notes at the bank at age 13 and 14 all the way through high school. $2,000 a year, we'd buy pigs, show them at the local county fair, and we funded 6 college educations, and yet these stories are going to discontinue because of CFPB. So when the CFPB is putting regulations in place that should apply to the trillion-dollar banks, what they're going to do is choke off the small local banks and choke off access to capital, and for just people who would never qualify for a loan at one of the big institutions. We just wouldn't. The rates of return are not there. They're going to fall outside the box. I'm hearing you all say you're not going to set up products. And so this hearing is extraordinarily valuable. I look at it as the CFPB has a de facto war on the poor, because it's the poor who are going to suffer when we don't have non-standard mortgages. I was pretty interested in Mr. Pinkett's discussion on, and one of my concerns, we talk about GSE reform and privatizing GSEs. I'll guarantee, as a small state, $31,000 per capita income, I worry that the rates of return are not going to be there, because Mr. Pinkett says that mainstream investors seeking higher rates of return would have us alter our decades-long focus on the most needy. And that's, I think, what's going to happen to the rural small areas if we have the GSEs that are totally free market. We're never going to have the rates of return in Mr. Pinkett's neighborhood or my neighborhood. And so what you'll do is you'll take away those 30-year loans for that part of the market, and again, starve us for capital. But you mentioned also, Mr. Pinkett, about the unregulated nonprofit institutions that you compete with. Could you expand that just a bit?
Well, in addition to the large banks and the credit unions, we also have nonprofit organizations that operate in the communities we're in, that are able to access capital from the large institutions, because it's debt capital, because they are unregulated, because they have a business model that allows them to repay their capital back in a much easier way than we would ever be able to do it, given the fact that in order for me to make a payment back to a bondholder, I'd have to get approval from at least 2 of my 3 regulators.
I appreciate that, and it's something that we don't see much, and so that's a viewpoint that I think is extraordinarily valuable for me today. Also, I think you all have adequately stated the same concerns our bankers are talking about in Basel III, that you weren't involved in any of the risky processes, but you're getting nailed with the same responsibilities, and your lending your portfolios don't look like those large institutions, but you're still having to have the same capital requirements, the increased risk weighting. We hear that constantly. I guess not many of you mentioned the appraisal situation. That's one thing I hear a lot in New Mexico, that the appraisals under CFPB have suddenly gotten very difficult. Is that something you all are experiencing? Just a yes or no is fine.
Yes, it's something we are experiencing. Matter of fact, we just went to an appraisal management company to try to comply with the regulation, which added to time and cost of the appraisal. And we found cases where we know the value of the property better than the appraiser because they're out of the area, or better yet, the appraiser cannot find the needed comps to fulfill the requirements, and as a result, the loan doesn't qualify for the secondary market. So
you bet. I'd hope to get some comment from everyone, but I'm going to squeeze one last question in, and that's on the flood insurance. Again, we're getting tremendous complaints on flood insurance. The last flood we had was back there when Noah was having his problems, and and we're getting stuck for what happened in Katrina, and so 1,000-year floodplains. Mr. Burgess, you had mentioned flood insurance in your written text. I don't know that you got to it. Expand on that just a bit, the problems you're facing.
Well, I think right now we're still trying to get our arms around the new rules, but I think one of the concerns we have is that the the penalties for a mistake are going from $500 to $2,000. And I guess one of the things we would ask is that you consider that penalty applying only to situations where there was actually not coverage on the loan for a period of time instead of just a technical violation.
Yes, and again, it's a real problem, not a problem that you let a date lapse by one day and you get stuck for $1,000.
Yes.
Thank you, Madam Chair.